true wealth is not having to work for it. It's actually getting your money to work for you.
I see it's been on the market for 228 days. That is a major red flag to me.
So the market is much more important than the property.
If you're a rascal, you're already making money. But wealth, real wealth, the kind that pays you even when you're off the clock. That comes from investing smarter, not hustling harder. Today, I'm sitting down with Jason Kenney, founder of Novo Capital, to break down one of the most powerful vehicles for building that kind of freedom, multifamily syndication. Jason's story is the real deal. He went from corporate America to discovering the truth behind passive income, the mistakes most people make, and why busy high performers like us should be thinking less about owning properties and more about owning equity in the right deals. If you want your money to start working for you as hard as you do, this episode is your blueprint. Let's dive in. Welcome, everyone, to Revenue Rascals. I have Jason Kenney here today, and this one's going to be all about real estate investments. Welcome, Jason.
Thank you. Thank you for having me. I'm happy to be here.
All right. So what I'm excited to jump right into right now, right off the bat, talk to me about the passive income trap.
Yeah, so passive income. Everybody seems to be the buzzword. Everybody wants passive income. The problem is people tend to do things that are not passive in order to get that income. So I was one of them, guilty as charged. A lot of us, we have this dream of real estate and we want to diversify into real estate. We want the supplemental income improvise, but we don't actually think through what that actually means and how to get it. And so a lot of us will start investing in our own properties or buying short-term rentals or even long-term rentals. And while those properties generate passive income, it takes a lot of active effort to do that. And so I experienced the same thing myself when I got started in real estate investing, decided I was going to build a portfolio, realized after a few transactions that it was anything but passive. The money came in every month, but I was spending a lot of time on nights and weekends analyzing properties and researching markets and overseeing the renovations and doing all the things that you don't want to do when you are looking for a passive income. So I call it the passive income trap because it's something that a lot of people fall into. And there are other ways, much more beneficial ways for most of us to invest in real estate that don't consume our time and probably make a lot more sense.
Well, Jason, I have won and lost personally inside the game of real estate. So I've had my heart broken and I've also been really happy clicking my heels. So tell me a little bit about your journey to where you're at today and, how you even went down this path of real estate's a good idea for me.
Before I got bit by the entrepreneurial bug, I was in corporate America for about 20 years. I was working as an analyst in information technology for about 10 years in financial services, another 10 years in medical. My wife also had a long corporate career in medical device sales. We spent a lot of that time just moving around the country. Michelle, we were chasing promotions and trying to climb the corporate ladder. And it was great for a while when it was just the two of us. But things changed when we started to have our family. The higher up that ladder that you climb, the more of yourself you have to give. You have more time, more responsibility. With more responsibility comes more stress. And especially for my wife, it was a lot more time away from home. She was traveling about every other week on and off a plane, living out of a suitcase. So it just started to burn us out. And after we started our family, I remember my wife having to go back and start traveling again. And she was crying because it was the first time she was going to have to leave our little guy since she had him. And I remember thinking, like, we had spent all these years, moving around the country and chasing titles and doing all these things. And we found ourselves in a position where we were going to have to pay somebody else to watch our children. Like, we were completely dependent on our incomes. We had no supplemental income. And up until that point in time, all the wealth that we did have was kind of locked up in retirement accounts and stuck in the stock market. So we decided we needed to make a change. We needed to make some adjustments, and we decided that we were going to be much more intentional with the incomes that we had literally spent like decades creating. And we were going to start consuming less and investing more. And we were going to start buying assets that generated income for us. And we thought that the best way at that time to do it was real estate. And I'm even more convinced of that today than I was back then. So that's kind of what got me started into real estate. Started on the single family residential side, buying, the ugly houses in the nice neighborhoods, and we would buy them and renovate them and fix them up and hold them for long-term cash flow. And that worked for a while. We built a small portfolio, but then came the passive income trap, right? The problem was it was really difficult to scale. We realized, a few transactions in that we were going to need a lot of houses to get to where we wanted to be. And probably the bigger problem, though, was the time, right? Like, having an analytical background, I like the research and analysis. I like diving into data, but I was spending a lot of time doing that. And, as a new dad, still working a W-2 at the time, like I really just didn't have that time to do that. And so it was working, but we needed a better way. And that's kind of when I stumbled across syndication. At that time, I didn't even know what syndication was, and I had been investing for a couple of years. So for those in the audience who might not know what syndication is, it's just a way for a group of investors to pool their resources together to invest in really large real estate that they wouldn't be able to buy on their own. So in my case, apartment buildings, but it could be storage units or medical office buildings. It doesn't really matter. And when you invest in a syndication, there's really two groups of partners. There's the general partner and the limited partners. General partner is the active investor, right? They're the ones that have management control. They make all the decisions and they're doing all the work. And then the limited partners are just bringing equity into the deal and they're 100% passive. So for folks like myself who are busy professionals or busy business owners, you might have the finances, but you don't have the time and you certainly probably don't have the experience. So that's a great way to invest in real estate and get all the benefits, the cash flow, the appreciation, the tax advantages, without having to sacrifice your time to do it. So that's been a game changer for us. Since we started, we've invested in, I think, 5 syndications. We're partners in over 1,200 units now. And it's been great. We get the steady recurring income. We get, all the tax benefits that are associated to it. And the best part is I just don't have to spend the time that I was spending before. So it's been great for us. My wife's been able to take a step back from her corporate career. She's not chasing titles anymore, and she gets to work from home full time. She's around our boys every day. She travels like a fraction of the time that she used to. And then, for myself, I've left my W-2 job. I started Novo Capital Management, which is a multifamily investment firm that focuses on helping accredited investors grow and preserve their wealth with multifamily real estate. So it's really been great for us. And my ultimate goal is to just build some long-term partnerships and to help other people kind of get the same level of freedom and flexibility that real estate has given to us.
My husband and I actually lost an enormous amount of money in a bad syndication deal.
Sure.
So what I want to talk about right now is what I learned after that disaster, but I want you to educate the audience of what to look for in that general manager that's basically either going to make you money or have you lose all your money, and like what you should look at when you decide, yes, I want to do this. How do you find the right syndication, the right general manager? What questions should be asked before you give somebody money?
Yeah, and that's a great segue, Michelle, because one of the things I did early on is develop a framework for myself to start looking at these different investments and asking the right questions, right? Being new to syndication myself, on the passive side, I had no idea what I was looking at. Like, all you see is numbers, you see IRR and cash on cash and equity multiples and all these buzzwords, and they all look great, except what a lot of people don't realize is it's just a story. When syndicators put that stuff together, that comes out of a model. That model is based on assumptions, and all it is in the beginning is a story. And it's the passive investor's job to make sure to vet those things and see how realistic that actually is. So when I got started, I put together a framework. I call it my SMART framework, and SMART stands for structure, model and assumptions, alignment of interest, risks, and then team. And so to answer your specific question, we'll focus on the team for just a second. So those are the types of questions that deal with how can you make sure that the syndicator or sponsorship team, because sometimes there's a group, really have the credibility and the capability to take that investment and make it successful. And so there's a lot of questions that you want to be asking. One of them would be, have they ever syndicated an investment before? And everybody has to start somewhere, but even if they haven't, they need to have a team who has experience doing these sorts of things, right? Another question you would want to ask is, have they done a syndication in the specific asset class that you're investing in, right? So I'll use multifamily, for example. Even in multifamily, you could be a new development or you could be in existing properties, right? So if somebody has only done existing properties and now they're syndicating and trying to raise money for a deal that they're doing new development on, if nobody on that team has ever done new development, you might run into some problems there. So you want to get an idea of their experience. You also want to get an idea of their track record, right? Most sponsors will be pretty transparent. If they're not, that's a red flag right off the bat. But you want to ask them, how many of these deals have you done? How many have performed based on your projections, and how many haven't? And for the ones that haven't, why? What went wrong, right? Anybody who tells you that every one of their investments has gone correctly is probably lying to you. That very rarely happens. Real estate has risks, just about like everything else. So, and you really want to have an honest conversation with the sponsor. So you want to be asking questions around their experience, who's in the team, who's making the decisions. I like to look for people who have gone full cycle. So it's easy to invest in properties when the market's going up, but that doesn't really tell you if somebody's a good manager or not. A lot of times the market's doing the heavy lifting for them. So I like to ask if people have invested through multiple cycles or at least one full cycle. And I like to see a sponsor who's taken a deal to fruition, right? So that can either be a refinance or that can be a sale. Anybody can buy a property, but then you actually have to manage it and you have to implement a business plan. So you really want somebody ideally who has taken that investment all the way through.
So your company, Novo, you are now the general manager and the syndicator, right? And you're taking on passive investors.
Yes.
So talk to me about why you chose multifamily and anything specific around multifamily, like certain types that you are really attracted to.
So I focus on value add multifamily, and I focus on value add because of the risk adjusted returns. So I mentioned a little bit earlier, you can do new development, and new development is great. It has potentially higher returns, but you are exposing yourself to more risk in those types of investments because there's no collateral. There's nothing there, right? You're starting from scratch. I like value add multifamily because you have an existing building, right? There's collateral there. It has a track record. You can see what expenses were there, how much revenue it's producing. And ideally, you're looking for properties that were mismanaged and that you see some potential upside. And so you get the best of both worlds. You get potential upside, but you also have stability in the fact that the property is already cash flowing. I look for stabilized assets that have operational inefficiencies. Some people like properties that are a little bit rougher than that, but once again, higher potential return, but there's more risk in those properties. So I focus on stable but undervalued multifamily assets, and I love the multifamily sector because history says it's one of the best places to invest your money. I don't know if you've ever heard of it, but there is a study that was done. I think it was released in 2015. And it was released by the Federal Reserve Bank of San Francisco. And it was called The Return of Everything, or The Return on Everything. And it was basically a 145-year study that looked at the 16 largest economies. And it found that residential real estate had the highest overall returns, the highest risk-adjusted returns. And so they looked at government bonds, they looked at equities, they looked at real estate. And real estate is the best performing asset class over the long term. And the reason I love that study, Michelle, is because it doesn't just focus on like a 10-year time frame where real estate was good or real estate was bad. I mean, this is 16 different countries, the largest economies over 145 years. So history says that residential real estate is a good place to be. And when I look at long-term fundamentals based on where the market is now, multifamily is in a really good position. We have a structural undersupply of housing in the US. We have a severe affordability crisis for people who are trying to get into single-family homes. And you have a situation where, although we've gotten a lot of supply in the multifamily market over the last year or two, because of high interest rates, that supply is falling off a cliff. And we're going to have a period here in the next year or two where demand is going to far outpace supply again, and you're going to have a good setup for higher rents, stronger valuations, and it's just going to be a really good time to be into multifamily real estate.
All right, Jason, I'm going to throw a curveball at you. Do you like curveballs?
I do, sure.
All right, fantastic. So
Baseball was my favorite sport. So
oh, fantastic. My dad played minor league baseball. And he was a coach for the Angels forever. And I'm always playing in like baseball analogy. Anyway, so I actually inquired on a multifamily listing off of Facebook Marketplace yesterday. And so he sent me the Crexy listing. It's multifamily. Are you down to look at it right now and give me your opinion on it for my audience?
So is this a property that you were looking at like as part of a syndication or as like a standalone purchase?
Standalone, however, I would be open to participating in a syndication or getting my friends together for one. So I'm not opposed to that. But this just came up the other day and I was like, oh, I want to check this out. So I am always looking for cool things. So first of all, I'm in Park City, Utah, and this 10-unit apartment building is located near Weber State University. So I'm attracted to multifamily that is supported by college housing needs. And so that's like where my head goes. However, I'm not the expert. That's why I brought you on. So let's go ahead and share this. So we're on YouTube right now, friends. So if you want to see what we're looking at, you will have to jump over to YouTube. But this is going to be a really fun conversation. So first of all, let's play a little game. When I'm looking at this, I see it's been on the market for 228 days. That is a major red flag to me. Would you agree?
Not necessarily.
Okay, talk to me about that.
One of the things I look for are opportunities potentially that other people don't see. Now, I'm sure there's a reason why that property has been on there for 228 days, but we don't know what the reason is yet. It could be the seller is asking an unrealistic price, in which case nobody's bidding on it, and so it's just sitting there. And one of the things that we have going on now is there's still somewhat of a disconnect between what sellers think their properties are worth and what buyers are actually willing to pay. So it's not unusual, at least at this point in time, to see multifamily properties that are sitting on the market.
Okay, well then let's see what else. So we're listed at 1.8 million bucks for this. Now, when I go through here, the rentable square feet, 7,400. One thing that I think is confusing to a lot of people is cap rate. So can you explain cap rate and what to look for in a listing similar to this?
Sure. So there's a lot of different resources for cap rate, and I'll get to those in a second. But generally, you want to get an idea of what the cap rates are in your given market, right? And you can get that from a broker, you can get that through websites. And actually, I should probably back up. So cap rates are a ratio, and it basically looks at a property's net operating income as a function of the price. So it's basically telling you what investors are willing to pay for the cash flow that the property is generating. And so cap rates move in opposite direction of the price. So as the cap rates fall, the price will go up. And as the prices go down, the inverse. So if you have compressing cap rates, so cap rates are shrinking, properties are getting more expensive, it basically means that investors view the market as favorable for whatever the reasons are, and they are willing to take less of a return and pay more for that asset. So lower cap rates can indicate a stronger investment opportunity. But it also means that you could be in a negative leverage scenario, right? So if you were because cap rates don't take into consideration financing costs, right? So it's just a net operating income. So it's the property's income minus their expenses, and a function of the price, right? So it's not looking at debt yet. So if you have a cap rate that's, let's say, 6%, but you have to take out a 6 or 6.5% loan to buy that property, you're now flat or negative leverage. So now you're investing in a property hoping that it appreciates, which is more speculating than investing. It could be a great investment, but I tend to look for properties that are positively leveraged. So cap rate, you would just want to get an idea of what the going cap rates are and then compare that to this and see if it's a reasonable cap rate. They're not really objective. People play around with cap rates. It's one of the assumptions I caution people to look at when you invest in a multifamily syndication, because that's a number that some syndicators will artificially lower to boost a future sale price. And that juices the returns on an investment, or makes it appear like it's going to return better than it might actually return. So I like to look for opportunities where the exit cap rate is the same as the going in cap rate. You shouldn't be lowering a cap rate and making any assumptions around cap rate, quite honestly.
So then when I look at this for the pro forma cap rate, which is higher than the regular cap rate, you're saying that is a good sign, if I'm understanding you correctly.
Yes, but the other thing to consider is pro forma is also just a story. So you have to verify.
I see what you're saying.
And you will see disclosures when you open these things up. You'll have to sign confidentiality agreements to get access to the financials. But every broker will have a disclosure, and it says basically it's up to you to verify the information. So based on the information that's in the story, the pro forma that they're telling you, that's what the cap rate is. But that may or may not be the actual cap rate.
All right. So just a couple more questions on here, and then we're going to move forward because I think this is such a great exercise. And I'm really impressed with the way that you're communicating the information to the audience as well, because everyone who listens to the show is an entrepreneur, a business owner, or a revenue leader. And that's like the top 1% earners in the world. So most of them are looking for ways to invest their money to do exactly what you did, which is to get yourself out of the time chasing game to make money and to actually see your money go to work for you. And so I think it's really important my audience understands all of these details to make good decisions and, also, be able to book a call with you if they want to, learn more about your syndication. So when I'm down here, I like a few things in here, and I'm curious what you have to say. So first of all, like I said, I like the idea of being close to a college campus. It's currently 100% occupied. That could be good or bad, I guess, in my eyes. They do feel like they can increase rents. So they're a little bit less than 20K can be increased. And then there's a lot of economic growth around Ogden, low vacancy rates, thriving community developments. I see these all as positives, but I also realize very much so that these are part of the story, like you're saying. So when I'm looking at this without putting in an NDA, engaging with the broker and getting all of the details, how does someone sort through just seeing a listing? Like, what is not part of the questionable story? Like, what is fact that you would have people look at in a listing like this?
The numbers are the facts, right? And even the numbers, until you actually get into due diligence, you don't necessarily know that those numbers are accurate, right? But I would say, at least at this point, when you're looking at a property, the numbers are what you have to go off of. So I would be looking at the financials that are provided, and I would be looking at the income that they say they're generating, and I would be comparing that to the rent roll. There's typically like two pieces of information you'll get: a rent roll and a T12 or a trailing 12 statement, right? And that T12 will show you what the operating income and operating expenses were for the property. So those are typically the first pieces of information you have. You should be checking those, because that is going to be really your indicator of whether or not that story that they were telling you is even reasonable or is even realistic. So I would be looking at those things. I would be looking at the income the property's generating. I would be looking at the expenses, and I would be considering what it's going to take to finance that property if you're using debt, and see if it's going to produce a return that's even reasonable and even worth your time. And then from there, you can dig into the details. But I will back up just and say this, Michelle. I tend to focus on markets first and properties second. So a lot of my time is spent looking at markets. And only then, when I've found the markets that I like, do I even bother with properties. So the market is much more important than the property. You can have a really great property in a mediocre market, and it may or may not turn out to be a good investment. You could have an okay property in a really good market, and the market is going to do a lot of the heavy lifting for you. So I would tell your audience, focus on the markets. You want to be in markets, to your point, where there's strong population, there's good economic drivers, right? There's a reason people want to be there. Maybe it's lifestyle, maybe it's weather. It doesn't really matter, but know the story and know the market. And once you're convinced on that, then start looking at properties in that market.
All right, rascals, let me ask you this. How much money have you wasted replacing shoes, sneakers, or even bags that could have lasted way longer if only you'd been taken better care of them? I know for me, running from meetings to kids' activities, life gets messy fast. And that's why I always have Jason Mark Quick Wipes on hand. Jason Mark is trusted care to help you get the most out of what you wear. They're not just about cleaning. They're about protecting what you love while protecting the planet. Their wipes are now 100% plant-based and plastic-free, made from renewable lyocell fibers. They're individually wrapped so you can toss them in your bag, your car, or like me, your kids' backpacks. And it's not just convenience. Jason Mark is part of the worldwide B Corp movement, meeting the highest standards for social and environmental impact. They're EPA Safer Choice certified, so you know the formulas are safe for your family. And their products are USDA, bio-based, and certified biodegradable. That means no harmful junk like PFAS or VOCs. Just high-performance care that keeps your stuff looking fresh while doing right by the planet. Personally, as a busy mom and entrepreneur, Quick Wipes are my favorite. They've saved my sneakers from coffee spills, playground dust, you name it. One wipe and I'm ready to walk into my next meeting looking sharp. So here's the deal. Go to jasonmark.com and use promo code Revenue Rascals at checkout for 25% off your order. One time per customer. Again, that's jasonmark.com, code Revenue Rascals. And remember, this podcast is free thanks to sponsors like Jason Mark. I'm ungating sales strategies people pay me six figures for. So go support them, grab your Quick Wipes or your favorite product, and keep your kicks looking fresh. All right, that makes great sense. So clearly a couple options here for people. You could go do it yourself or do a syndication. Talk to us, other than the time commitment for doing it yourself, what are some other advantages of being a part of a syndication versus doing it all on your own?
Yeah, so there's pros and cons and everything, right? If you're doing it on your own, you have 100% of the income. You get to keep all the income, right? But you also have 100% of the liability. So if somebody sues you, if you didn't set up your asset protection correctly, I know your audience is entrepreneurs, high income earners. If you didn't set that up correctly, that might not just cause problems with the real estate you owned. That may cause problems with your other assets as well. So you need to understand the liability aspect of it. So yes, you get 100% of the income, but you also have 100% of the liability. To your point, you also have a time commitment if you do the active side of it. And I guess the other benefit would be all the tax benefits flow directly to you since you are the only owner, right? But if you go the passive route, you don't have 100% of the income. You share in the income, but you also share in the liability. Your liability is limited to the amount of your initial investment. You also get tax benefits that don't flow directly to you. They flow to everybody that's involved in the syndication. So you'll get a K-1 statement at the end of the year from your sponsor. And if, especially now, that bonus depreciation, 100% bonus depreciation was restored, if a syndicator or sponsor is using depreciation or bonus depreciation through a cost segregation study, you will likely get a passive write-off on the income that you received. So you'll still get plenty of tax benefits from investing in a syndication. And then, of course, the other upside is the time aspect of it, right? Like a lot of us are busy. We have families, we have jobs, we have careers, we have businesses. We want the benefits of real estate. We want the appreciation. We want the cash flow, the supplemental income, the tax shelters, but we don't really have the time for it. And so for folks that are in that situation, syndication can be a great way to get exposure to real estate. I would say know what your investment goals are, know the risks that you're willing to take. If you are early in your career and you want to take some more risks, invest in a new development. If you just want steady cash flow and you don't want to undertake that kind of a risk-adjusted return, then take a core asset, a brand new asset, 2 or 3 years old, and just ride out the cash flow. It'll be lower, but it'll be a much more stable investment. There's going to be much less maintenance costs, and insurance costs are going to be cheaper. It'll be easier property to operate. There's less risk. Or if you want some blend of the two, multifamily value add is a great opportunity. So it really just depends on what your objectives and what your risk tolerance are.
Yeah, that makes great sense to me. So let's talk a little bit and expand on tax benefits right now, because that's always on someone's mind who's listening to this show. So, there's certain ways that you can limit your tax liability within your business. But many people listening to this, when they take their owner distributions or they pay themselves, their personal income becomes their liability for taxes. So I'm curious, because I can't remember when it comes to when you're a part of a syndication, the tax benefits go directly to personal income, if I'm correct, right?
They do. They go to ordinary income, except they can be offset by not only the business's expenses, the syndication's expenses, but also the depreciation deductions that syndication takes. So oftentimes you'll find that the cash flow that you got is essentially tax-free because the depreciation outweighed the income that property actually produced.
Yeah, that makes great sense. Thank you for clarifying that. I was like, I think I remember this appropriately, but it's been a hot minute. Okay, awesome. So what's a belief about business or growth that you strongly disagree with that most people accept as true? I mean, I love to hear your story from the 9 to 5 to, doing your own investments and now owning your own syndication. Like, talk to us about something you're just not going to prescribe to.
Yeah, for me, it's this idea that you can earn your way to freedom, that you can earn your way to wealth. I have experienced it, and I don't believe it. Wealth to me is how long you can go without having to work. It's not how big your bank account is. It's how long can you survive without working. And you could argue that CEOs make great money, and that's true, but they have to work. They have to still work to get that money, right? So for me, true wealth is not having to work for it. It's actually getting your money to work for you. And I'm not saying everybody should quit their job and invest in real estate, but we should be using the money that we've earned to generate future wealth for us. So, my wife and I, we spent most of our careers moving around, chasing promotions, and we were earning a great living, Michelle, but it came at a cost. The problem you run into is the lifestyle trap, because inevitably, the more money you earn, the more money you start to spend. Maybe a few really, really disciplined people don't run into this, but most of us will run into this problem, right? You'll move into a larger house. Your kids might want to go to private school. You don't want to have the Hyundai in the driveway when the neighbors have the Mercedes. So you upgrade your car, and then you take nicer vacations. And so all of these things start to happen, and they happen to everybody. And if all we're doing is earning our livings, oftentimes we find that we have obligated ourselves to things that have now overcome our incomes. And so we have to work even harder. And so the best way to get out of that trap is to, in my mind, acquire assets, whether that's a cash flowing business, whether it's cash flowing real estate, but acquire assets that will actually appreciate in value over the long term and provide cash flow for you that you can use now as well.
I've never heard anything more true in my life. That is 100% true. I'm guilty of it. So I think most of us are at one period of your time. You just keep upgrading. The kids get more expensive, the hobbies, the sports, all of the things, and I think if I was to go back to my younger self when I was making $250,000 a year at 23, I should have done some things differently.
I would say the same thing, Michelle. I grew up, my family, I came from a broken home. My mother was divorced and I lost contact with her. And so I was basically living on my own as a young teenager. And, my grandmother, thank God, was a guiding light in my life at that particular point. And all my grandmother knew was go to school, study hard, get a good job. Right. And it seemed like really good advice at the time. I had nothing else going for me at that time. And I did all those things. And for a while, it provided a good life for me. And my wife has a similar background to myself, but it only takes you so far. And then that lifestyle creep happens. And then we're all, struggling. I saw a study recently that 60% of high income earners, and this was defined as people earning over $300,000 a year, are struggling to pay their bills. That is a sad state of affairs when we're earning hundreds of thousands of dollars and we're struggling to pay our bills. So earning money is not the way to financial freedom. It's not the way to get our time back. Investing wisely, investing smart is the way to do that.
100%. I think about what I made when I was 23 and, I own my own business now. It's very different. Like I'm playing that game. That's my scaling my income, all the things. But occasionally I go to just see like what that job pays now, like what I used to do, because I recruit for sales roles. And so I'm like educating myself and I'll go back and it has maybe increased by 10%. And I'm like, wait, So inflation is out of this world. Everything is so expensive. I now have a family I need to support, and you're telling me the role pays exactly the same than 20 years ago. And I don't think sales roles are the only ones that are having that same problem. So friends, if you have somebody in your life that is under the age of 30, please share this. So if they won't listen to you, let them listen to Michelle and Jason right now.
Michelle, there's a great website. It's called shadowstats.com. And what they do is they calculate inflation based on the way it used to be calculated in the 1980s. Then I think again in the 1990s, and then the way they calculate it now. And if you look at the way inflation used to be calculated in the 1980s, before we had all this stuff, substitution and all these other things that they've done, it's running at about twice the reported rate. So even at 3% inflation, which is what is officially being reported, give or take, we're really at around 6% if we calculate inflation the same way we did back then. So, and even if inflation was what the Federal Reserve says they want it to be, which is 2%, then by definition, their goal is to have prices going up 2% every year. That's what they want. That's what they're trying to do. So even if they're hitting their goals, over time, inflation is going to outpace our earnings. I mean, it's just the way it works.
Yeah, it's absolutely happened. And, I'm just sitting here very grateful that I chose owning a business. So, and, I'm not going to say I'll never do a syndication before, but man, did that hurt. That hurt.
I think, and I don't know the backstory with yours. I think, and you're not the only one, Michelle. I talked to many people who have had some unfortunate investments in syndication, especially over the last few years. And what I would say is, I don't think people really understood the risks that they were taking. And I do think some syndicators and sponsors probably misrepresented.
Well, Jason, I'll say we just got in with a bad guy. Like, we did our due diligence and we just missed the bad guy signals. It makes me, someone actually told me after it all happened, they're like, you should hire a private investigator next time and make sure you're dealing with the right guy. So, I think sometimes you just get the bad guy, right? And unfortunately, that happened for us. Oh, sad. Oh, man. All right. So my closing question right now, which I absolutely love to ask all of my guests, is what's the most rascal thing you've done in business where you disrupted, broke rules, or innovated in a way that shook things up?
Back when I was doing single family residential, I was into creative finance and looking for ways to acquire properties that didn't require traditional financing. And there's a variety of ways to do that, except every time I had to figure out what those numbers were. It was time consuming and it was difficult to do. So I ended up just building my own model, really, that you would basically input the criteria for the investment, and it would spit out multiple offers based on how you wanted to take down that property. So whether it was a seller carryback or a variety of other creative finance, like loan assumptions or wrap mortgages, so I would have it set up so that I could plug in the criteria, and then I would be able to look at the potential multiple offers and see which one made the most sense for me. So that was probably how I think I innovated the most in my real estate career.
I love that. And you've also included your Smart Passive Investors checklist here for the audience as well. So we will make sure that we drop that into the show notes. You can go to Novo Capital Management.com. That's MGMT to of course learn more about working with Jason if you're interested, and YouTube at Hassle-Free Wealth. And I just want to say that you have made me excited again for one day to do a syndication. It's selfishly why I wanted you to come on this show, so that I could air my grievances and maybe talk to somebody who was doing it right. So
I appreciate the opportunity. I had a great conversation. I'm grateful that you had me on, Michelle. Thank you.
Amazing. Wonderful. All right, everyone. That's a wrap, and we'll see you next time. Thanks for listening to Revenue Rascals, where we turn bold ideas into predictable revenue and prove that breaking the rules can still build empires. If you love what you heard, do me a favor. Tap the links in the show notes to support our sponsors. They're the ones keeping this show free so I can keep ungating the six-figure strategies that help you scale faster, lead smarter, and take more freedom home with you. And hey, if you think you'd make an incredible guest or know someone who's built something worth studying, email me at hello@michelleterpstra.com. And until next time, stay sharp, stay bold, and stay just a little bit rascal.